All right, good morning and good afternoon, depending on where you're located. Welcome to the year-end payroll checklist webinar hosted by yours truly, Neil Koplitz. On the line with me, I have a guest panelist by the name of Bill Larkin. And if you were on a few weeks ago, Bill recently gave a webinar on the state of HR technology, and I've asked him to join us in case there are any questions that I might not be able to answer. So welcome, Bill. So with that, again, I would like to welcome everybody that's on the line. During today's webinar, there are going to be 4 polling questions. And as most of you are on not only just to learn about year-end, but also to get your CPE credits. In order to get your credits, we need you to participate in the surveys, and trust me, we can track you. So we know who's going to be responding. So please respond to the 4 questions. They are simple yes and no questions, and it gives us a guidance on how to proceed forward, not just for today's webinar, but for future webinars. So with that being said, in case you miss any part of the webinar, if you need to step out or if you need to reference back to anything, all of the presentations are available in the handout section of the webinar on the right side of your screen. So please feel free to download anything, and if you miss the ability to download it, email me directly and I'll be more than happy to share it with you. And although I'll say it several times again throughout the presentation, my name is Neil Koplitz and my email address is neil.koplitz, as you see the spelling on your screen, at sikich.com. So with that, I'm going to move on and say welcome. This presentation is designed to assist your individual organization with preparing and completing the year-end process. The idea of this is to add simplicity and to add ease to the heavy burden that is year-end. For any of us in payroll, we all know this is our crazy time of year. People say, oh, are you taking off between Christmas and New Year? No, we're not. We're in payroll. It's not an option for us. So we're hoping that this webinar is going to be a tool to help you organize and have a successful and accurate year-end. Basically, this program is divided up into 3 unique phases. Even though year-end has 2 phases, I've added on what I call my post-year-end phase. So phase 1 is, what are the things that we should be doing now before the calendar year ends? What are the things that we want to accomplish before December 31st and to obtain our greatest levels of accuracy? Then phase 2 is, what do we do after the year ends? On January 1st, what are the things that we have to do, not only to ensure that W-2s are right, but that the first paycheck of the year is going to be accurate? And then another big piece that I have found with a lot of organizations is, what do you do with a person who claimed exempt on a W-4? And what are the rules and regulations around claiming exempt? So with that, I'm going to jump right into phase 1. And because I know how much you folks are all out there looking forward to the polling questions, we're going to jump right into our first polling question. And that's, does your payroll department or HR department have a year-end checklist that you may have utilized from last year or that you use year to year? So I'm going to give you about 30 to 45 seconds to register your votes, and we're going to talk about the votes once I see that most of you have voted. Checklists are so important to make sure that you don't miss anything from year to year. Having a checklist also enables you to look back on what did I do right last year and what did we do wrong last year? How do we learn from our mistakes? How do we learn from the past so that we know that everything is going to be as accurate as possible for next year? So with most of you voting already, I'm going to close the poll, and I see that 80% of you have checklists from last year and 20% of you do not. For the 20% who do not, you have my email address. Reach out and I can send you some basic information on how to start your checklist and some basic hints as to what you may need on that checklist, things that I'm going to discuss during this webinar and things that I may not discuss during this webinar. Because again, everybody has specifics considering what industry or what area your payroll is in. All right, so as I talked about, our phase one is what do we do before December 31st? And a lot of you are probably running through a million things in your head right now saying, okay, let's see what Neil covers and I know what I have. So first thing that I always say, let's check the employee's indicative data. Now, what does that mean? Let's make sure that employees are going into either their self-service or looking at their pay statements. Is my home address correct? Have I moved? Have I moved more than once? Not just for tax purposes, but for those of you who are maybe larger employers and have several thousand W-2s that you're putting out. We keep the post office pretty busy on getting, and our mailroom pretty busy on all the returned W-2s and all the returned 1095s that we almost have to hire a clerk just for that time of the year to organize and to potentially resend out or update employees' home addresses. So I keep telling people, too much communication, no such thing. Communicate over and over and over again, whether it be through messages on the pay statement, email blasts, whatever it takes to get your employees to keep updating their home addresses. Even in self-service, and when they sign on, have a screen pop up. Did you update your home address? Is your address correct? Maybe that you're a new employee, and when someone entered in your street, instead of hitting 1, 2, 3, somebody had a fat finger and hit 1, 2, 3, 4 or 1, 2, 4. It always pays. Just take a few minutes and look over everything. From an employer perspective, make sure that all of your employer information is right, that your employer ID is right, your FEIN. Make sure that the number on your W-2 is the correct number and the same number that you used on all your quarterlies. Then the third thing with the indicative data is review the employees that are going to require the pension indicator box to be checked. And as you know, whether the person participates in the plan or not, if they're eligible in accordance with your ERISA plan, with your individual plan, if they're eligible for it, whether they participate or not, that box needs to get checked off. Now, here's a big thing that I know I've experienced in the past, getting all the notices from the IRS that Social Security numbers are wrong. And as you know, there are penalties associated with a bad Social Security number. Now, I know we all do our due diligence throughout the year. As we hire a new employee, they go through whether it's the E-Verify process or you have another service that's doing it for you. We verify Social Security numbers, but unfortunately, not everyone does a complete job 100% of the time, and some things fall through the cracks. So it's important to know that a Social Security number or an ITIN, the identification number, they will never, ever begin with the number 8. The IRS has saved that number 8 for when the population grows so much that they need to start utilizing those, and they have not done so yet. All of the ITINs all begin with the number 9. Now, there's a second section to the ITIN, and that's also known as Part 2. The 4th and 5th digits, they can only range between 70 and 88, 90 to 92, and 94 through 99. So if you have a number, those two numbers in the middle that are highlighted in yellow, if you have a number, let's say 21, 22, 35, you know that you've got a bad identification number. And as you know, the IRS, they may impose a penalty for each Form W-2 that has a missing or incorrect Social Security number or a bad employee name. And we're going to talk about the employee names in a moment. Employee names may not contain an apostrophe or a dash. So if someone is an O'Connor, let's say, the apostrophe cannot be in because the Social Security card, it's not a viable number, and not a viable symbol. Unless, please forgive me, I'm sorry, unless you have junior or senior on your Social Security card, it may not be used on the W-2. It's very important because if junior or senior appears on the W-2 and it's not on the Social Security card, you will receive a penalty for an incorrect name. One of the biggest things that I've seen, unfortunately, is how do we handle a deceased employee's W-2 and or 1099? There is a defined process to properly handle the wages of an employee from before they were deceased and then after they were deceased. I know it's not a pleasant subject, but we all have to deal with it. There is a 1099 process involved in this, as well as a W-2 process. Please look into your IRS regulations as to what is appropriate for your company. And if you need any guidelines or guidance on it, I can send you some IRS documentation. Email me your specific request, and I will be sure to be able to take care of that for you. All right, so now we're getting into checking wages, taxes, and benefits data. You want to confirm that all of your deferred compensation plan types are correct, and you want to verify all of the employee contribution amounts. You want to make sure that, let's say if it's 401k, 403b, 457b, any other of your qualified plans, those all have limitations from the IRS, including the catch-up contributions for those who are over age 50. Any employee who has exceeded that amount, you want to catch before year end and refund it through payroll so that all of the tax consequences are reversed. So it no longer is a pre-tax income, it becomes taxable. Now, with that being said, you want to move on to your group term life insurance. You want to make sure that anything that the group term life insurance amounts in excess of $50,000 have been included in taxable wages. Now, there's no such thing as saying, okay, for $75,000, this is the amount. No, not true. What happens is it's based upon the dollar amount over $50,000 with an age factor built in. So check with your group term life insurance supplier or the vendor as to what those amounts are and how to impute them onto the employee's wages. I recommend that you do it paycheck by paycheck and not wait until the end of the year, because it is a taxable event and we don't want to create any undue hardships on the employee at the end of the year by imputing income at the end of the year that could have been spread out through the year. Now, we do have one exception to group term life insurance. State of Pennsylvania. The state of Pennsylvania is the only state in the country that excludes group term life insurance from taxable income. So if you have employees in Pennsylvania, make sure that your payroll system is set up so that the group term life is not added to their income for Pennsylvania purposes. Oh, sorry about that. You want to make sure for your unemployment insurance rates, as they change annually, your experience rating goes up, can go up or down every single year. Also, the taxable wage-based limits for each state vary from state to state and potentially can change year to year based upon different legislation and changes in the legislation on a state-by-state basis. So you want to make sure that you go back, that you're looking at your unemployment, ensuring that your rates are correct, and then move forward. Although those amounts are not on the W-2, that is a major expense to any company. You want to make sure that that expense is correct, and you want to make sure that it's also that you're not under or overstated. You want to then take a look at what's called your uncollected Social Security and Medicare taxes for either retirees or former employees, or even employees if you're in a tipped environment and you have an allocation of tips. And we can talk about allocations separately, but if you have tips that are allocated at the end of the year and the employee may not have enough net pay to cover their Social Security and Medicare, the IRS does make allowances for those amounts to be posted onto the W-2, and it then becomes a responsibility of the employee and not the employer. Now, as an employer, you are still obligated to make the employer match on the uncollected taxes, but you are not responsible for the employee portion so long as it is clearly stated and identified on the W-2. And there are specialized boxes for that purpose. All right, let's talk about wages, taxes, and benefits data. All such fun and exciting stuff. We want to ensure that other special tax items have been updated to be included in the person's wages so that it automatically and naturally flows through onto the W-2 form. Things that you want to look at are what we call other compensation, whether it's bonuses, commissions, any type of incentive plans, and that those things are added onto the employee's paycheck. Even if it's paid through another source, that the amount gets imputed onto the employee's paycheck so that the value is added to their gross wages and taxed appropriately. You want to go through your employees' business expense reimbursements to make sure that there aren't items that could potentially be taxable. Now, within expense reimbursements, when I talk about taxable items, and we'll talk about a little later, you have things such as spousal travel, which, unless as a designated business purpose, spousal travel is taxable. And it doesn't necessarily have to be a spouse. It could be anyone that is traveling with you that the company has paid for, could then be considered income to you. You have taxable fringe benefits, such as the employer contribution to the HSAs. I go to the gym 100 times this year, I get $100. Those amounts are taxable. If your company still has domestic partnership benefits, there is a portion of that, of the benefit, that is considered taxable. Now, those can get complicated, so I recommend that if you have domestic partnership items, please partner with your HR department and partner with your benefits provider to ensure accurate reporting of the domestic partnership taxable benefit. For those of you in situations where in the hospitality industry or other industries where you have tips, and the IRS has specific guidelines as to the amount of tips that must be reported based upon revenue. And if those amounts aren't met, that's when you have an allocation that comes into play. You would be utilizing IRS Form 8027 if you have the situation where you have tipped employees, and that will determine if you then have to add income to individual employees, and that would be based upon a IRS approved method by which to allocate out tips amongst all tip eligible employees. And again, if you need more information on that, please email me directly. You have dependent care benefits that you then need to pay tax on for things such as after school care and things of that nature. Again, partner with your HR department and your benefits provider to determine the level of taxation on those benefits. And again, the same would hold true for any employer paid items, whether it be for relocation, education assistance above and beyond the IRS limit of $5,250 per year. And remember, when we're talking about educational reimbursements, the IRS goes based upon constructive receipt. So even though the person may have finished the course in 2019, if the reimbursement is paid in 2020, it's still considered 2020 income. It's very important to look at your fringe benefit checklist. Make sure that all the taxable withholdings have been properly updated. Some of the areas where I recommend that you go through and update them, paycheck by paycheck, month by month, quarter by quarter, are amounts such as the ones listed here that I'm going to go through. And these amounts could produce a very large taxable impact on the employee. Items such as third-party sick pay, and that's where a third party is paying your employee for time not worked, but still has to be reported on a W-2. And there are different methodologies by which to handle that. You have personal use of company vehicles and private air travel. When you're using a chartered jet, there are income implications. If, let's say, your CEO or CFO uses a private jet for travel, there is a dollar value associated with that. Non-qualified moving expenses. As you know, the laws changed recently, and there's a much stricter level of attention and, unfortunately, taxation that goes along with moving expenses. Company provided transportation and parking in excess of the IRS limits. Employer paid education not related to the employee's jobs, as we just previously discussed. Non-accountable business expenses such as spousal travel, purchase of gift cards for other employees, etc. You have bonuses and other special payments that we talked about earlier. You have things such as non-cash payments and gifts. You give somebody a gold watch for their retirement. In some circumstances, there is imputed value on that gift. I also recommend that you go through all of these items that you're putting through your payroll and make sure that all of the required backup withholding has been done properly. As we get through phase one, you want to run what I call mock or test W-2s on your previous quarters. Ensure that your Social Security and Medicare wages are in balance. Ensure that any previous quarter's amendments are completed and filed so that your year end is going to be properly in balance. If you have voids from previous quarters, a voided check from a previous quarter, that previous quarter needs to be amended properly. I recommend that you pass your Social Security numbers through any of the multiple available testing sites or verification sites to validate that you have appropriate Social Security numbers. And again, run queries or run reports so that you are not exceeding any of your ceiling amounts on whether it be savings plans, HSAs, FSAs, and non-taxable tuition reimbursements. So then I recommend, last but not least, just to run through these special checks. Check for any special or bonus runs that you may need before the end of the year. Many employers give out a year-end bonus. They want it to be taxable in the current tax year, so you may need to check with your payroll provider or your IT department or your HRIS group to ensure that you have a bonus run set up. Make sure you schedule at least one adjustment run. And the adjustment run can happen in the subsequent year, but it does need to be dated in the previous year. And again, based upon your payroll provider, you may or may not be allowed to do that, but make sure you have one scheduled. Request any special reports that you need for year end from your payroll provider or your HRIS group. Make sure that when you go back to payroll today, make sure that you've got enough stock for running all of the things that need to get run at the end of the year. Make sure you have enough check stock. Some employers like to hand their employees live checks for their bonuses at the end of the year. If they're doing so, make sure you have enough paper stock, your check paper stock. Make sure you have enough blank W-2 forms, enough blank 1095s, etc. Remind all your employees to fill out new W-4 forms if their situations have changed. Change of life events, going from exempt to non-exempt. Obtain your new forms, Form W-5, if you have advanced earned income credit. Go through all of your hand or manual checks to make sure that your system's been updated accordingly. Make sure that you have voided or reversed all paychecks that have potentially been either returned, canceled, voided, direct deposit returned and replaced. Make sure that you're clearing all of those out. You don't want to have an employee's income artificially inflated because you forgot to void a check. And then make sure, and we're going to talk about this later, that any employees claiming exempt status completes a new W-4 form by February 15th of the next year. Now, guess what? We've got a polling question. Does your company and or entity have a test environment, and do you run your W-2s through the test environment prior to year end? Do you run W-2s throughout the year for testing? So we're going to take about 30 seconds. I see people are answering. I like to do test runs throughout the year. I personally like to do test W-2s each and every quarter so that when I get to fourth quarter, all I have to worry about is the balancing items within that last quarter. I don't have to search for one missing check through 365 days worth of data that I don't have 52 weeks to search through. So we're getting ready to close the poll, and we have 34% of you actually do run test W-2s throughout the year, and 66% of you do not. My recommendation, as you probably can figure it out, is run mock W-2s at least twice a year. It will make your life at year end so much easier. All right, now we're ready to go into payroll check, the phase 2. Phase 2 is what are the things that we do after January 1st. All right. We want to review and update any discrepancies that may have been identified. Update the mailing addresses, social security numbers. Check your purge coding for any terminated employees. You want to clean up your database for employees that are X number of years old based upon your individual company's requirements. Some companies don't purge at all. It's up to you. It's a business decision, not anything that's guided by the IRS. Ensure that all terminated employees have zero balances for loans, garnishments, vacation balances, sick time balances, etc. These discrepancies may have been uncovered while you're doing the last payroll of the year. Make sure you do make sure that you've gotten everything accounted for and adjusted. Determine whether or not your earned income credit has been submitted properly. Review any discrepancies such as individual negative quarter earnings or negative year-to-dates on any fields, and especially your qualified pension plans and your qualified deferrals. Review your new state unemployment and insurance tax rates. Make sure the new wage limits are updated as we spoke about earlier. Look at your state disability insurance rates. They too can change year to year. And those are again based upon state requirements. Test the reasonableness of your Social Security tax withholding. Multiply your total wages, the total wages less any excess for the annual limit, and multiply it by 6.2%. Take a reasonability check. Look at your employer match against what's been withheld. Your only discrepancy on that should be uncollected Social Security and Medicare, of course. Test the reasonableness for your Medicare by 1.45% and look at all of your IRS mandated employee paid Medicare surcharge. That's the 0.09% in excess of $200,000 in wages. Okay, take a look at your payroll registers. Make sure that when you go from your register totals to your Form W-3 subtotals, that there's reasonability. Make sure that those numbers can tie out. Make sure that you're taking into account pre-tax totals, taxable totals, imputed income. Compare your W-2 forms to your state and local tax reports. Reconcile any differences before you submit. Anything that's out of balance will come back to you and get rejected from the IRS. Make sure that all of your totals of taxes remitted to the IRS equal your W-3 summary reports. Check and make sure that all of your contributions and distributions from your cafeteria plan items for child care and medical care reimbursements are all done and have been effectively handled. Check and make sure that your excess contributions to qualified plans have been returned. Make sure you're looking at your highly compensated employees. You don't want to risk your ERISA plans. Check and make sure that all required tip allocations have been completed for tipped employees and that the employee tax and taxable blocks look at your exempt employees who are no longer exempt and make sure that those blocks have been removed, because you don't want to start the new year incorrectly. And that applies to anybody who may be changing visa types from an HB1 to a different type of work visa that may now require Social Security or Medicare taxes to be withheld. Make sure that all your fringe benefits have been imputed accordingly, and make sure that all of your special accumulators have been reset to 0 before the new year starts. Make sure that those adjustment runs and your special bonus runs have been done. Make sure that your managerial reports for the upcoming year have correct parameters. Make sure that your pay dates are falling within the right quarter. When you're setting up your calendar for next year, it's vital to make sure that none of your pay days fall on a federal banking holiday. You want to make sure that you've adjusted those accordingly. Work with your company's GL or accounting department to make sure your month-end and quarter-end dates fall within their specified fiscal periods. Make sure that accrual amounts are up to date and that all of the new annual limits on your FICA and employment taxes are correct. You want to make sure that you're partnering with your human resources department, your benefits department, your IT and help desk group, your finance department, your general leadership group, your general ledger groups, and your C-suite partners to make sure that you've covered all of the bases and everything that goes into processing year end. Prior to closing the old year and starting the new year, communicate with all of your partners to make sure that you've got a green light to move forward. Polling question number 3. Does your company send out email reminders for employees to check their home addresses in either self-service or on their pay statements? Yes or no? And again, we've spoken about this several times during this presentation and the importance of getting everything correctly on their home addresses, not just for taxation, but for all of the returns that come into play when you're talking about all the forms that you're sending out. And it's not only a nuisance, but it's costly. Postage for each item. Think about that. If you've got several hundred returns, that could be several $100s that it's costing you. We're getting ready to close the poll, and I see 54% of you do send out reminders to employees and 46% of you do not. Again, not to beat that dead horse or pour salt in that open wound, but consider sending out reminders. It will save you so much hassle in the future. I'm going to quickly review claiming exempt on a W-4 as we are starting to run close on time. So claiming exempt on a W-4. When an employee claims exempt, it means that they are exempt from federal tax only. Some employers may tell their employees that they need to do a form each and every year, which is required by law. Things that you want to make sure that you're doing is, how do you adjust the employee's payroll for it? And what are your employer's as the employer, what is your responsibility? When an employee begins working for you, of course, they have to complete a W-4 form. Employees can use this form for personal allowances as well as claiming exempt. You can provide definition as to what a box number is on the W-4 form, but you can never, ever provide tax advice or guidance. It will leave your company in a liability situation. The employee can also complete state forms to be withheld from individual state requirements. A W-4 form claiming exempt on a W form does not exempt an employee from Medicare or Social Security. Those have other special qualifiers and need to be completed separately. There are special circumstances where a work visa or a special type of visa may overrule that circumstance. If a person wants to claim exempt from state and local taxes, they need to complete the state and local form. In order to do so, the federal form will not roll into your exemption status. Students who are part-time or seasonal, or employees who are part-time or seasonal may claim exempt, but need to do so year after year. Students, seasonal employees, part-times are not automatically exempt from federal, state, and local taxes. Employees must use the form to tell you that they're exempt. It may not be verbal, it may not be an email. Employers are required to keep those forms, whether it be electronically or hard copy. Last of the 4 questions. Does your payroll department change an employee to maximum withholding if they do not submit a new W-4 after claiming exempt status? As you know, February 15th is the deadline, and if they don't return a new exemption form by February 15th, they are legally subject to maximum withholding. Now, that does not mean you go retroactively backwards to the beginning of the year. It means from February 16th forward that they are maximum withholding. I'm going to give it another few seconds because the votes are still popping in. And we're going to close it in a moment. And we are closed. And surprisingly, it's just about 50-50 where the no's actually have it slightly over the yeses. 49% of you do go back into the employees, 51% of you do not. Understand, for the 51% of you who do not, the IRS has implications to you for not changing it. And you can then be liable for that withholding amount. Now, if an employee falsely claims exempt and you have the W-4 form to prove it, it is no longer your or an employer situation or issue. It is an employee issue to deal with the IRS. The IRS will provide you what's called a lock-in letter. That means the employee has either under withheld or not paid their taxes, and the IRS is looking to get their money, and they tell you this employee A, must be single zero, let's say, unless you get a release from us. An employee can send in 100 W-4 forms. It doesn't matter. Once you receive that lock-in letter, you are obligated to withhold as the IRS states or more. You can't go less, but you can go more if the employee is looking to get their tax obligation fulfilled sooner rather than later. At this point in time, I'm going to open up for some questions that have been submitted throughout the organization. And let's give me 1 second as we get through. Okay. The first question is, this was covered under housekeeping. The first question that somebody asked, are these slides available? Yes, they are. I know I started to speed up near the end, so you can download this entire presentation from the handout section on the webinar control panel, or you can email me directly at neil.koplitz@sikich.com, and I will be more than happy to send you the presentation directly. Another question that just came in. This is a great question. Is there such a thing as a default Social Security number if the Social Security number is bad? And yes, the IRS says any bad Social Security number, or if an employee has identified as a bad Social Security number, you are to use all 9s to submit that employee's W-2 data. Now, it doesn't mean that let's say you have 10 people who have bad socials. You do not combine all 10 into one W-2. You must still submit 10 separate W-2s utilizing all 9s. Okay, one of the big questions that came in multiple times, and I apologize, I should have been clearer. What is an ITIN? What does it stand for? And an ITIN is an individual taxpayer identification number. And you say, well, how is that different from a Social Security number? Well, where that's different is somebody may be authorized to work in the United States. They don't have a Social Security number because they're not going to be collecting Social Security benefits in the future, but they want withholding tax to be done or need withholding tax to be done. And therefore, we have an individual taxpayer identification number. Couple of questions that have come in about the new W-4 form. Once the IRS has designated their final version of the new W-4 form, which unfortunately, as of this date, has not been done, we will do our best to communicate to you the changes as quickly as possible, and potentially I may host another webinar on how to go through this, on how to go through the W-4 form, the new W-4. What I can say about the new W-4 form is that it is only the only obligated party to complete a new W-4 form are new employees. An existing employee will only need to do a new W-4 form if they want to change their withholding. So it is vital that you communicate with your payroll provider, whether it be the service or your internal IT group, to make sure that you've received whatever patches to your system are necessary to do the translation from an individual's income level to their marital status and to the number of allowances that they're claiming, to have that translate to a new dollar value, which is withheld per paycheck. And that is still subject to change based upon if the employee has more than just hours within or salary within their payroll. All right, so okay, I just went over that question. I'm just looking at the different questions. Another question came in is, what are non-cash payments? A non-cash payment, as I said, can be something as simple as a gold watch given to somebody for hitting a milestone anniversary, 10 years work. You're giving out gift cards to employees for X dollar amount. That amount would then be imputed onto the individual's paycheck, and taxes would be paid on those amounts. A big one, and one of the newer biggies, is moving expenses. Almost all of moving expenses have now been deemed taxable. Even if your company paid a third party directly. Let's say you have Johnny is moving from New York to Chicago, and you hired a moving truck to move Johnny's possessions, and you paid the moving company directly $5,000. Well, even though you paid that third party, that $5,000 needs to be imputed onto Johnny's paycheck and taxed appropriately and identified on the W-2 as taxable relocation. Is there a de minimis rule? That's a very interesting question that just came in. Is there a de minimis rule when it comes to gift cards and or non-cash payments? I can give you the IRS answer, and that's no. There is no such thing as a de minimis rule. The IRS states any income earned must be reported. Now, on the flip side, some companies have made a business decision to define a de minimis amount. Some companies may say $25. Some companies may say $50. Again, those are individual company decisions that the company has made and is willing to accept risk to. The thing that I caution when you set de minimis amounts, make sure that your de minimis amount is a year-to-date total. So hypothetically, if your company should deem $25 as a de minimis amount, but you're giving out a $25 gift card to the same employee each month, it's $25 times 12 months. So that's no longer a de minimis amount, it's a couple of $100s. I think we have time for one more question. And it says, can we accept new exempt W-4s at the end of December on the 2019 version, or will they need a 2020 version? Now, technically, when an employee gives you a new W-4 form, it needs to go into effect the very next paycheck. The rule on claiming exempt goes by the calendar, and that's December 31st. So the employee will need to complete a new 2020 W-4 form in order to continue the exempt status. I know it seems ridiculous since there's only a couple of weeks left to the end of the year. Why can't it just roll? But don't shoot the messenger. It is what it is, and unfortunately the IRS is very strict on their guidelines. So with that being said, we are at the end of our time. I'd like to thank each and every one of you for participating in this call. Please feel free to email me at neil.koplitz@sikich.com should you have any individual questions pertaining to your company or your individual unique situation. And we'd be happy to get back to you. And if you need the presentation, again, be happy to send it to you. Thank you again. And thank you for participating in this webinar. Bye-bye.